Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be taking a look at the S&P 500, but really looking at the broader picture on the S&P 500, looking at the monetary cycle that drives asset prices. I truly believe that monetary policy is what drives the market. If you look at what happened in March 2020, the Federal Reserve effectively prevented a major bear market. They prevented a drawn-out recession from occurring during a global pandemic. They essentially delayed what would have been a major depression, a major recession. Now that caused an economic boom, but even more so, it caused asset prices to rise exponentially, more specifically equities. But now, in 2021, as I'm making this video, we are starting to see signs of this policy shifting. So we're going to go through in this video whether we can continue to expect that shift in policy, what's going to happen to the markets, right? Because easy monetary policy propped up the markets in 2020. Will that have the direct opposite effect in 2022? Now, of course, if you've been watching our other videos, you'll be watching this video confused and asking yourself, but Peter, you said that there's still a lot of upside left on this bull run, and you're absolutely correct. There is, from the research that we've made, we're still well within a bull run. We're still expecting a lot of upside and very likely to see a rally much past 5,000 points in the next few months. But this video is not going to be focusing on what's happening in the next few months. I'm going to be focusing on the broader stock market and economic cycle, and what I'm going to talk about in this video are things that could happen late 2022 or even 2023, depending on whether we see other events that stretch out the cycle, like Omicron stretched out the cycle. If you're interested in following these crazy markets with us, putting your financial education into historical perspective, we take deep dives into how macro works and how it compares to different moments in history, and most importantly, how we can benefit from it. Make sure to click on that subscribe button. And now, without further ado, let's get right into it. All right, so I want to begin with this chart right here that I made of the monetary policy cycle. I think this is the most simple and yet most accurate representation of how it works, of how monetary policy works. We'll begin with the easing phase. For example, what we had at the beginning of 2020, the response to the pandemic, the response to global shutdowns was an easy monetary policy. Interest rates dropped, and that caused asset prices to rise. It caused economic growth and eventually inflation, right? And so that's the part of the cycle where we're currently at. We've seen asset prices rise. We've seen economic growth pick up. We've seen inflation rise. And now we're getting into the part of the cycle where we're going to see central banks begin tightening. Now, once they've begin tightening, that's when asset prices fall, growth slows down, and you have the inverse effect of what we had throughout 2020 and throughout 2021. Inflation falls, it creates an economic downturn, markets drop, and in response to that, they eventually ease monetary policy again, and that's why it's an ever-ending cycle. Now, from my understanding, all recessions, all bear markets, all downturns have been triggered systematically by a tightening of monetary policy with no exception. And I can show you that with this chart here. This is the federal fund rate, so this is the interest rate of the Federal Reserve. It shows you whether they're tightening or easing monetary policy. When they're tightening, they're raising the rate. When they're easing, they're lowering the rate. And you can see back here in 2004, 2005, they were raising the rates here in 2006. That eventually triggered the housing bubble to burst and the great financial crisis. In 1999, they raised rates as equities were going on a parabolic run, especially the tech sector was going on a parabolic run here, and that popped the bubble, created the dot-com bust, and plunged the United States into a recession throughout 1990 and 1991, and quite a sizable drop on the stock market. That was around a 20% drop following that rate hike. Then, of course, going back to 1981, they raised rates. That triggered the 1980 to 1983 recession. That was only a 30% drop, but inflation adjusted, I believe that was more than a 50% drop in the real price of equities. And I could go on like this, looking at every single bear market, every single recession, going back to 1929. In fact, even the 1937 recession right here was caused by a combination of rate hikes and quantitative tightening, which caused another 3-4 year depression following the Great Depression, right? So none of these bear markets, none of these recessions happen by accident. They are all part of this cycle. So where are we currently in that cycle? Now, of course, we still have the federal fund rate at 0. Right? So we haven't seen any type of tightening yet. So I'd say we're somewhere in this phase here between growth and inflation and the beginning of tightening. Now, again, remind yourself, assets perform extremely well in this phase. There's still growth, there's still inflation, and we haven't even seen the beginning of monetary tightening, right? Typically in this cycle, assets rise here. When there's just been easing, they rise here, and they even rise when the Fed is tightening. It's only when they go too far that assets begin to fall. So the question is, are they going to begin tightening now? Because if they do, then we know that we're getting closer to that point in the cycle where assets begin to fall, and that could potentially come as soon as 2022 if they begin to aggressively tighten monetary policy now to slow down that inflation that we're currently seeing, that for the month of November printed a 6.88% increase in consumer prices. So is that going to continue trending up? And I'm going to show you a couple of charts here from NFIB. This is a survey for small businesses, and they ask a simple question: what is your most important problem? And this chart shows you when inflation throughout the last 20 years has been the most important problem. Now, of course, that doesn't include small businesses like Game of Trades. Our single most important problem for our business is the like button. So if you want to help us with that, make sure to smash it as hard as you can. It really does help our videos get pushed out by the YouTube algorithm. We put a lot of effort and research into these videos, put out our convictions, and trying to help as many people as possible. If you're looking to help out our videos, help out the channel and our service, do not forget to click on that like button. It is really appreciated. And you can see how impressive this chart is, climbing to the same highs that we had right before the great financial crisis, which caused the Federal Reserve to tighten monetary policy too aggressively and cause a financial crisis. And if we take a look at another couple of charts here, these are charts showing you the percentage of businesses that are planning to raise their selling price. And you can see this just never stops to go up. It just continues going up and up to similar levels we had throughout the 1970s, where inflation was a big problem. Now, keep in mind, this is planning to raise their prices. Now, of course, they've already raised their prices, but they're still planning to continue raising their prices. And you can see that's typically a leading indicator of CPI. It leads the CPI, so the inflation rate, by a few months. So inflationary pressures are there. Inflationary pressures are very likely to remain intact. And so I think that's going to force the Fed to raise the federal fund rate much faster than expected. They're already announcing 2 to 3 rate hikes in 2022. I believe they're going to go through with that at the very least. Now, a big part of our investment strategy and our trading strategy are based on monetary policy, what growth is doing, what inflation is doing, and we try to go deep into the data, deep into the charts, deep into the statistics to determine our own macro strategy throughout the next couple of years, and hopefully try to communicate it with you guys as best as possible. Because the point of all this is that you can be successful in both an environment where asset prices are rising and when they are falling. And if you're able to profit from both environments, risk on and risk off, that can tremendously impact the gains that you make over a long period of time. And we have every intent on using that strategy and hopefully helping you guys understand the vision and the research that goes behind this. Okay, so that you might be asking yourself this question. All tightening cycles do not necessarily end up causing a great financial crisis and triggering massive drops on the S&P 500, right? You take the example of the 89 recession, it only caused a 20% drop on stocks. So why do we think that this tightening cycle is going to have a big negative impact on the stock market? And I'm going to answer that question in just a couple of charts here. First of all, this is the 10-year forward annualized return. This is the S&P 500 return that you would have got throughout the next 10 years had you invested at that particular moment. So I'm going to illustrate that. Had you invested back in 2011, right here, throughout the following 10 years, you would have got around a 10 to 15% annualized return on your investment between 2011 and 2021. Now, had you invested back in 1999, for example, well, throughout the next 10 years, between 1999 and 2009, your average annualized return throughout the next 10 years would have been around negative 5%. So you would have lost an average of 5% per year throughout the next 10 years. So that's a big deal. And you'll quickly notice here that throughout the past 150 years, we've been oscillating up and down within a clear range between around 10-15% and around negative 10 to negative 5%. And that's why we say that when you have 10 good years on the stock market, it usually means you're going to get 10 bad years in the next 10 years. And you can see where we're currently at here. We're clearly at the upper end of this range. We're clearly at a point where equity returns typically begin to reverse, typically begin to roll over. Now, that doesn't necessarily happen straight away, right? It needs a trigger. It needs an event, like a great financial crisis, like a dot-com bust. So that's the first reason why I think the next tightening cycle will likely cause a severe drop in equities. The second reason is highlighted in this chart here. It's the US profit margins throughout the last 50 years. And it shows you this trend of US profit margins that gradually goes up over time with a linear trend that goes in the middle. Typically, you have profit margins go up and down around that linear trend, but it always reverts back to that mean. And that's why they created this other chart here, which essentially calculates how far the profit margins are from that trend, right? So it calculates the space between that blue line and that dotted line, and it gives you a horizontal chart. Now here you can see throughout 2021, we've had profit margins expand massively. Now that's great for the stock market. That has driven the stock market very high, and that's been extremely profitable throughout this bull run. But you can see here that we're getting to that point where profit margins eventually contract and revert back to the mean, and that tends to be bad for stocks. And you can see the last time it was this high was in 2007. And we all know what happened in 2007. You had a severe drop in the stock market because investors went from pricing in great equities and great profit margins and great earnings, and everything was optimistic. And then once monetary tightening began to take effect and impact the economy, those profit margins contracted and stocks fell. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed this episode. It did take quite some time to research and produce. If you enjoyed it, make sure to click on that like button. And now, in the meantime, I wish you good luck on your trading and see you next time.